Hi there, it's Callum Newman. I'm one of the editors here at Fat Tail Investment Research, and today I've got Catherine Cashmore on the end of the line or end of the Zoom call, and we're going to be talking all things property from the First Lady of Australian real estate, as I like to call her. So, Catherine, we've talked a little bit about this over the year. Way back at the start, you were calling for a bounce and a stop in the falls, similar to Louis Christopher, who came out at the time. He said Sydney and Perth would be the strongest. Is it fair to say that's played out so far in 2023?
Yes, we have a market recovery going on of sorts. I'm not saying that values are soaring or anything crazy is happening out there. We just don't have a credit surge to create that kind of craziness. But certainly values have recovered. And the latest news this week is that WA's market has now hit a record 768 billion in total value. So I did an interview with Akhil Patel a few weeks ago where we were talking about, we're going into this kind of potential boom in the last 2 years of the property cycle. And he made a really good point in that, which is wherever you might live, you might not be seeing the boom where you are. But globally, there's so much going on, and that the places that are obviously advantaging from commodity, from the commodity cycle, from extra infrastructure being planned and created, like the China Belt and Road project, which is going on across continents. And that's where the gains are going to be seen the most. And so WA's market has now hit record figures. Other markets are recovering, however. We have in Victoria, the Victorian market total value now is 2.55 trillion. Which is not quite where it was in 2022 when rates were at 0.1%, but it is certainly on its way up. And that's why I think it's like, it's an interesting market, particularly if you are in Melbourne, as I am, and working the market in Melbourne, as I am. And that is that, we're not actually seeing a huge upsurge on the ground in Melbourne. The properties do still need to be priced appropriately in order to sell. And there are a lot of investors that are still offloading their properties due to the rise in rates and Daniel Andrews' little policy changes that are not exciting investors at the moment.
So where are the investors going to go? You're thinking still WA and Queensland?
It's interesting. Obviously I get contacted all the time by people that are wanting to buy or sell, and a lot of them are saying to me now, well, should we buy New South Wales rather than Victoria? And the reasoning for thinking something like that is that we are coming to the peaky stage of the cycle. And if you are going to be buying at this stage of the cycle, you want to be sure that you're going to get something in the first half of the next cycle, unless you're speculating to buy and sell at the peak, which is a real risky game right at this point. You've got to buy the right product, you've got to be able to add value to it, and then you've got to be able to offload it prior to any substantial downturn. And it's very hard to time the market like that. So the investors that are thinking of buying at the moment, and they're holding, say, for the next 10 years, and they are thinking about New South Wales and Victoria. And Victoria, we've had the land tax changes in Victoria where the threshold has been lowered. So that means that's brought a lot more people into the land tax bracket. And we've also had talk in Victoria about rent freezes, which aren't going ahead now. So that's one thing that is positive for people that are investing in real estate. But it did cause a few nerves in the market. And so people were saying to me, well, why do we want to invest in Victoria when they're not only hitting us with higher land tax, but they're also talking about rent freezes? We'll just go to New South Wales. Some of them have turned around, and the problem is once they turn around and say, okay, we'll invest in Melbourne, because Melbourne's got a lot going for it. We've got storming population growth. We've got our vacancy rates have dropped very low, and we do have very consistent growth in Melbourne through the first half and the second half of the cycle, and the options here are far more affordable than New South Wales. But the first thing they remind me of when they do decide to invest in Melbourne is that we have the highest rate of stamp duty in Australia. So it's
I was under the impression, and correct me if I'm wrong, that it was Southeast Queensland that had a higher growth rate. So is it like native born or sort of Australians here already are going to Queensland, and then the people coming from overseas coming into Victoria, New South Wales as usual.
Southeast Queensland did pip other states over the last few years. Over the longer term, you'll certainly see Melbourne and Sydney get the lion's share of population growth. But what's the problem with Southeast Queensland is it's just so decentralised. I mean, not everybody goes into Brisbane, whereas if they're coming to Victoria, there's a large percentage that go into Melbourne rather than the regional towns. So that's why you just don't get, that's why you have to monitor where the population growth is going. And as we've always said, we've been working together for long enough where, I said population growth is vital in order for land values to rise, but it's got to be population growth going into areas that are that have a low land supply, accessible land supply. So in other words, landlocked suburbs where you can't sprawl out because there's other suburbs around it. So the only way to accommodate a higher population is to subdivide the land within that area. So population growth is really vital in Australia to get any kind of land price inflation, but it has to go hand in hand with understanding, what the lay of the land is and making sure that you're going to an area where there's a shortage of accessible land supply.
So I'm just thinking, if we go back last year, there was fears of a big crash, so that's now off the table. I mean, I can only tell you off the stock market, but I don't get a sense that the wider community feels that it's very, very exciting, the prospects of property. The stocks are still pretty subdued. Do you think people will be surprised in the next couple of years by the strength of Aussie property?
I think that every year we look at Aussie property and people will say, I don't think it can go any higher than it is now, and then a few years later it's kind of eclipsed that point and people are saying the same then. I don't know how it can get any higher, and because there's a lot of drivers that go into it, but ultimately the problem with property, right, is it's a big purchase. You need a lot of money up front in order to step in, typically. Over the longer game, you're kind of guaranteed more than you are over the shorter term. But you can make a lot of mistakes in property and you can lose money. And I think particularly over what's happened in this cycle, it is no longer as easy as you just go and buy a good piece of real estate and then you hold it for 5 years, because I know people that purchased 5 years ago and are trying to sell into the current market and not getting any increase on the price that they purchased. Had they sold at the peak at the beginning of 2022, they would have done. But we've now had the rate rises. We had a very strong pullback through 2022. We're only just recovering from that now in Victoria. And if you own a property, which really is a development site, which is whereas most of the value is in the land rather than any property that might be on top, basically you've got a knockdown suburban house, hasn't got much value, but you've got a great block of land. There aren't developers in the market. So you put it on the market, the land has value, the bank will allow you to borrow against any equity that's in it. But if you're trying to turn it into cash on the open market, you could have extended days on market and a real struggle because developers just aren't common in the market. And those properties are really struggling. Now, 5 years ago, if you'd have told someone that when we're looking at 2018, and you'd have said, well, this is all going to happen. You have COVID, rocketing rates, and the build price, a record number of builders going into administration, then you wouldn't have purchased that type of product. But that's where the cycle is just very elusive. It's very hard to play the cycle. Sometimes you have to use a little bit more now. So the way to get around that, Cal, really is whatever property you buy. And we had this discussion not long ago because we were talking about your place. But whatever property that you buy, you've got to make sure that it appeals to a real broad buyer demographic. So if it appeals to developers, that's great. If you want to do a development and you buy a property that's a development site and you have plans to do a development in the future, fantastic. But if you want to turn it into money, you need to turn it into money at the right point in the cycle. But if it is a property that appeals to developers because it's got land value, good land value to it, but it's also got a decent home, so it appeals to home buyers. And perhaps the development potential is that you can build behind the existing home. So you've got a lot more potential then for, people to consider it as a home because they can make extra income from the backyard and so on and so forth. So you have like broader buyer demographics that are interested. That type of property, if you're trying to turn it over today and you purchased it in 2018, you do a lot better than you are right now. But it's still the case, the market's struggling a little bit in Melbourne. I know it's pulled back a little bit in Sydney. Good properties are selling well, but properties have to be priced right for the market.
And so, I mean, in terms of interest rates, I would assume most people carry in their mind that interest rates up, property down, and the reverse kind of thing. It's not always true, though, is it? There are instances when rates have risen or stayed high and property's still gone up.
Yeah, I mean, I think the lesson in that is what's happening right now, and that is that, you know, the initial shock, the interest rates going up in 2022 did shock the market and caused a lot of uncertainty, and people felt, well, you know, if I buy now and rates go up another, you know, so much percentage points, then that's going to affect my budget. So if they had to buy, they pulled their budget back. And those people that didn't have to buy thought, well, we'll step out of the market. And you had that huge downturn, you know, through 2022, big pullback. Now people have got a little bit more confidence. They've got used to the rate hiking cycle. They're coming back into the market and you're seeing recovery. And so you're seeing, you know, places like WA that are now hitting record as a total value of their real estate, of their residential real estate, are now hitting record levels, despite interest rates continuing to inch up over the year. And, you know, we know, right? So this is all about the cycle. We can't analyze the market without the cycle. If you drop that knowledge, then you might as well be a weather forecaster just looking out the window and thinking, well, rates are going up, property prices must be coming down. But we know historically, when we look back at the previous two cycles, how when rates rose, property prices rose alongside them. And so we had that dynamic playing out in the second half of the cycle then, just as it's playing out now. And because now all the talk is, well, are we going to see interest rates dropped? I mean, it's not my forecast, but there's people out there that are talking about that. And certainly if we do, that's going to make a real interesting turn in the market, isn't it? Particularly for people that aren't expecting that we are entering, you know, what we're forecasting, which is a recession/depression into 2028.
Yeah, it's going to be interesting to see. And I mean, just my observation, you mentioned the REITs just before we started, actually. The property trusts that trade on the stock exchange have stabilized at least. They have taken a beating over the last 18 months, all to do with the interest rate dynamic that's gone on. So I do think the market's getting comfortable with where rates are at. And rightly or wrongly, for the moment, the peak is either here or very close. So there's every chance that they do come down a little bit next year. We'll have to wait and see. But again, that would be a further tailwind. I know I saw him quoted in the paper saying that he thinks the famous FOMO is going to start kicking in because there's not a lot of stock around. And if prices keep rising, people are going to realize that they have to act to get in.
If there's one person I trust, if there's one person I trust on short-term movements in the property market, it's Louis, because he's got a better record than anybody out there for forecasting those types of things. So he's certainly worth taking note of. I mean, he really does the analysis and, you know, runs his research company, and you know, they collect all the research, and it's arguably better and more reliable research than any of our other data agencies, you know, CoreLogic and Domain. So I mean, I really do trust what he says, and I think that there's definitely potential for that when you look ahead. You know, we've got, I mean, immigration, there's a lot that's been talked about it in the mainstream, but there's a lot that's been talked about it in the non-mainstream media as well. And I've interviewed Leith Van Onselen, who writes Macro Business, and Cameron Murray, who have been talking about this and saying, well, look, you know, we've got record low vacancy rates. Rents can't keep rising because they are to some extent tied to the cash people have in their pockets. So, you know, to wages, but so people will start crowding in houses in order to be able to moderate those rental rises. You know, we'll see perhaps a little bit more crowding, but there is demand for it. And he's right. If people start to see property prices continue to rise, the logic will be, let's get into the market. They don't want to be caught on a rental ladder where they can face you know, being pushed out of a property and not being able to find something else suitable for the family. So it's definitely something to think about. But I mean, when I think about, you know, you were talking about REITs, and when I think about this, the piece that I wrote for the monthly edition last month was, is there an 18-year cycle in Australia? And I think this is where we're very Australian focused here, because obviously we want Australians to make money from the cycle. And the cycle in Australia runs a little bit differently as it does in other countries, you know, from how it does overseas. And from that, I mean that we are a small population and a small market in comparison. And if you try and chart any 18-year cycle on any metric, in Australia, you can't find it. You can't find it in median property prices because of the volatility of government intervention now, and you can't find it in total sales to GDP. You can't find it in financial data. Maybe, you know, if you combined all of that and really looked for it, then you can identify it, but you can also identify other downturns, which is why really that we look to the US. And one of the things that you can really identify in the US compared to Australia is the REIT market and the building companies peaking out prior to the end of the cycle, and giving you that indication that once they start going down and you don't see recovery in that, and you're reading the chart and you're realizing that, you know, they're on a downward spiral, then we know that we're approaching the peak. And certainly at the moment, that's not flashing red in the building companies in the US. You keep an eye on these things. What are you seeing over there?
Yeah, no, definitely the US market has fooled the property market fooled everybody this this year, last year, and this year. And so a lot of those companies have rallied really hard for 6 months of this year as the market realized that everybody came way too bearish. The US is different to Australia because so many of their mortgage holders are on very low fixed rates. So even though the rates are going over there, the existing homeowners aren't feeling it because they have fixed rates for 30 years. So a lot of them are, and sort of strangely enough, it's made the market over there tighter because no one wants to move because they don't want to give up their cheap mortgage. So it's funny how the world plays out, but yeah, it's definitely different to what the dynamic here in Australia, because we've got the so-called fixed rate cliff and people are rolling over to higher rates. So that is crimping consumer spending. But as of now, the US is looking really strong, and probably the strongest economy in the world. Well, not probably, most definitely the strongest. So no, in terms of leading the world up, it's still doing what it's historically done. So that's really interesting as well. So in terms of people watching this, you're then happy if they're interested. I was just thinking too that the ASX, in terms of the stock market, it hasn't done much for a couple of years. So people may be incentivized to go to property. It's been volatile, but the returns haven't been that flash. So that may also push people back towards property just for that feeling of security that so many people do seek in property. Sort of to summarize then, you're still seeing opportunities sort of, I guess, Australia-wide. Is there any state that you wouldn't go to?
There's a couple of states that have really kind of passed perhaps their peak of the cycle, Tasmania and Canberra, where you're seeing, you know, the market come back rather than, you know, increase. But, you know, this is all about, it's not just about location. You know, property is about, it's about the type of property you buy is just as important as the location that you buy it in. And there's general rules that you have to follow. And so the general rule in terms of the cycle is right now, if you're playing the cycle, then anything in the smaller states by population, you've got to get out at the peak based on what happens in Australia historically, because then you're looking at a flat first half of the next cycle, and you're looking at potentially, if you don't get out at the peak, you've lost your gains and you've got years of a plateau ahead of you. That's just a general rule. If you are buying now and you want to hold on for the next 10 years, then definitely there's advantages to be happening buying now, because potentially you're buying ahead of the winner's curse, which is very lucrative. You're buying ahead of the downturn into 2028. We've spoken a lot about things that can happen to extend that downturn, but assuming that it doesn't and it plays out like the cycles have previously, you're then looking at the government stimulating the market and the peak of the previous cycle being exceeded in the first half of the next cycle. And that means that you've got the gains in the first half as well. And then by the time you get, you know, to the mid-cycle of where we're going into the next cycle, then you've really established yourself well. And if you've played that well, then you'll be entering the development cycle in the first half of the next cycle. And so if you've got land with development potential, you can potentially take advantage of that. You can leverage up your portfolio at those stages of the cycle. But right now, you know, yeah, I mean, there's potential for a boom over the next couple of years. And however you play that, whether you're playing it on the stock market and you're taking advantage of what I think is going to happen to REITs, and I think we're going to see opportunities there. We're going to see recoveries depending on which REIT it is and where the exposure is. Obviously, you've got to be still a little bit careful about the office market and what types of offices are getting the demand. It's only really A-grade offices that are doing that. And what I mean by that, offices that are set up as a hybrid model, and they really, there's a shortage of those rather than, you know, the general office vacancies, which are still pretty elevated. So you know, you just got to be wise and understand what's going to happen over the next 2 years, and you know, where to put your money, where to put the exposure. But definitely, if we did see a rate cut, I think everybody understands that that's going to, under the current circumstances, really stimulate the property market in the last couple of years of this cycle. And then you might see rates raised again towards the peak in order to slow down the property market, rather than to, you know, what's happening now, which is more looking at the general economy and inflation going on in the general economy and trying to get a handle on that. So yeah, there's still opportunities that are out there. There's a lot to think about. I mean, there's a lot to think about in terms of what's going to happen in the next cycle, Cal. I mean, AI and the technological boom that we're seeing at the moment will create enormous profits over the next few years. And it's the locations where those profits are created that will achieve the gains as
Yes.
yeah, I mean, you know, the land values are going to achieve those gains. So really thinking about that, and I might write about something like that for this monthly edition, but really thinking about you know, where those gains are going to be if you're buying real estate, and how you can take advantage of that. And we might even see that in construction. You know, we've spoken about it before with 3D printing. It has come to Australia, albeit we're very slow and we're very behind. But there are, you know, opportunities there. And I've actually just joined the board of Grounded, which is Australia's first community land trust organisation with so we're looking at 3D printing and that to assist in there as well. I mean, it's really interesting times. It's very exciting when you look at it from the outside. Understanding how to make money from it is a challenge, but there's certainly many opportunities there to take advantage of.
Absolutely. All right. Well, let's leave it there. And of course, if anybody is interested in further stuff, they can just call you or follow you on Twitter and follow all your writing and stuff, because there is so many things that driving the property market and all the things that change and the pieces shuffle around again. So you do have to stay on top of things. So thank you for this chat today. It's been good.
Thanks, Cal. I always enjoy talking to you. And you're on Twitter as well, and they should certainly go and find both of us on there.
Yeah, absolutely. All right. We'll do it again soon.
Okay. All right, we'll talk soon. Thanks.
Oh.